So now we're going to start with understanding of the financial statements which are required from a project manager perspective. That is a balance sheet, income statement, and statement of cash flow. First, let's begin with balance sheet, or commonly known as statement of financial position. So what does a balance sheet represent? The balance sheet, which is also called as statement of financial position, this represents the amount of assets, liabilities, equity, and their relationship at a specific time, mostly at the end of the year. So we can say that balance sheet is just representing the statement of financial position, the condition of the financial position of an entity on a particular point of time. One transaction and the entire balance sheet can change. So if you have ever noticed a balance sheet in your life, or I'll just suggest go ahead and see any balance sheet, it will always say balance sheet as on dash day. It always says as on a particular day. It never says for the period so and so. It never covers any amount of period. It just states balance sheet as on a particular day. So the balance sheet, it helps the users to assess the liquidity, the financial flexibility, the risk the company is carrying, and so on. By balance sheet, the companies get an idea how much amount is the company carrying by way of loans, how much has the owners invested in the entity, how much assets they are holding, how much their data is outstanding, how much cash, bank, liquid cash is there with them, and so on. The elements of balance sheet are assets, liabilities, and equity. And there's a golden rule is that there's a relationship defined between the various elements of balance sheet, which is assets will always be equal to your liabilities plus your equity. Basically, this means that all the assets are going to be financed by your liabilities and your equity. Equity is basically the owner's money, stockholders' equity. It comprises of various elements and all of that, but I just don't want you all to be bothered with the entire depth of financial statements because that's not relevant from a project manager perspective. But however, what's relevant will be caught for sure. So first of all, let's understand what is assets. The assets are the resources controlled by the entity or owned by the entity as a result of the past events. They represent the future probable economic benefits the assets are going to give to the entity. This was a bookish definition. To be honest, assets are those elements or those benefits which the company has accrued over the past by performing its past events, by performing the activities till now, whichever they perform, and gotten itself in the condition that they hold the assets now. Example will be the inventory. Entity purchased the inventory in the past and now it's controlling the inventory as of now. That's why it's there on their financial statements. A result of a past event, benefit for the future. The property, plant, and equipment, the investment, account receivables, everything is linked to performing some activity in the past because of which the ownership has passed to the entity as of now. That's why they are coming in the asset side of the balance sheet. Similarly, liabilities, they are the present obligations of the entity arising from the past event. Their settlement is expected to result in an outflow of the economic benefit for the entity. Example includes the loans, bond issued by the company, accounts payable, vendors of the company. Company purchased the goods on credit in the past because of which it has to pay its vendors on a balance sheet date. Hence, they are a part of liabilities. Generally speaking, equity is the balance of the liabilities amount reduced from the asset. In other way, you can say the assets which are financed by way of liabilities, balance in that is equity. That is, they are financed by the owner's money, the equity of the company. Example of equity includes the common stock, preferred stock, retained earnings, and such things. Retained earnings is nothing but past undistributed profit. Remember this golden thing. Retained earnings or reserves and surplus basically means past undistributed profit. The company had generated profit in the past period, but they did not distribute to the owners. They did not put it to some other use, and that's why they are lying in reserves and surplus as of now. So, I hope with this you got a basic idea of what is an asset, liability, and equity. This is what comprises your balance sheet. Now, before we go ahead, I just want to take you into a depth of assets and liabilities. How are they classified first? Assets are classified as into two categories, current assets and non-current assets. Current asset is classified as a current asset or you can say a current item on the statement of financial position if it is expected to be realized in cash or sold or consumed by the entity within their operating cycle or 1 year, whichever is longer. So before we go ahead, let me just give you a quick description of an operating cycle. Operating cycle is a point of time when the company purchases it completes one operating cycle. Basically, from the point of time a company is purchasing its inventory to the point of time it's sold and cash is realized against that sale, that is one operating cycle for an entity. So suppose in case of a manufacturing unit, let me just put this way. Suppose if a computer chips manufacturer, they procured the inventory on 1st of Jan. They prepared the computer chip by 15th of Jan. The chips were sold on 20th of Jan and the cash was realized on 30th of January. So in this case, the operating cycle lasted for a period of 30 days, that is 1 month. From the point of procurement of the chips to the point of realization of that chip or the final product, that is one operating cycle. So now if you remember, I had said this thing over here, the asset is classified as a current item on the financial statement if it is expected to be realized in cash or sold or consumed within the entity's operating cycle or 1 year, whichever is longer. That is, if it is probable that the asset is going to be converted into a cash or benefit is going to be realized within the next 1 year or the operating cycle, whichever is longer, then it's an current asset. Now, if you have strike a question in your mind that at what point of time can the operating cycle be more than 1 year? How is it possible that company takes more than 1 year to develop the product and sell it? You're on the right track. You're getting a good hang of the financial statements now. But let me tell you this thing. There are certain exceptional industries where it takes more than 1 year of time to convert the asset to a finished product and sell it and realize the cash. The best example will be a construction industry. Imagine this thing, construction of a high-end tower, okay, a skyscraper, which is going to have a residential flats as well as commercial flats, commercial spaces and everything. But will that construction be complete within the 1 year? Will the construction commence on Jan 1st and guaranteedly complete on December 31st? In 99%, it's not going to be done, right? So there, the operating cycle is definitely going to be more than 1 year because the manufacturing or the preparation of the raw materials with the finished goods itself is going to take them for more than 1 year of time. And because of that, their operating cycles is going to be the higher of the 1 year side. It can be 3 years, 5 years, anything, till the point they're sure that this is a time by which we realize to expect collect the cash. So in those exceptional industries, the operating cycles do go for more than 1 year. Now the major categories or the major items which are included in the current assets are cash and cash equivalents because they are readily realizable in cash. They can be realized as in how you want to sell them. Certain individual trading items, that is the securities which are available for sale and they are held for trading part, like a company invested in the shares of a certain company just to play the price. It intends to sell it in the next 15 days itself. So it's going to be available for sale. The held for trading, the intention itself is to trade it on a regular basis. Inventories, the prepaid expenses, because they are paid in cash, but the benefit is expected to be realized in the next 1 year itself. Those are the kind of current assets. Non-current assets. Now these are those assets which do not qualify as a current asset first of all. So any item which is not qualified as a current asset comes in the category of non-current asset. Ideally, in a way, assets which are going to take more than 1 year or the operating cycle to be realized. Now, the major category in these non-current assets are investment and funds that are intended to be held by the entity for a period of more than 1 year or the operating cycle. So, investments in securities made to control or influence another entity and other non-current securities. So, whenever companies invest in other entities' securities, other entities' shares or investment in their bonds, and when they issue debentures and so on, the intention is to hold them for at least a 5 to 10 years period till the time they're going to be realizing a good amount of returns. So those investments which are not going to be sold or realized in the next 1 year, they are going to be your long-term asset, basically non-current assets. Next is a property, plant and equipment. Now, property, plant and equipment, these are the tangible operating items that have been recorded at cost and they are reported at the net of accumulated depreciation basically. So suppose you have a machinery that has a life of 5 years. It's already running in the 3rd year. Do you think it's fair to report the value at which you purchase a machinery back before 3 years, supposing for $100,000, and the end of 5 years, the machinery value is going to be $0? So does it make sense to report the machinery value still at a value of $100,000 at the 3rd year end also? No, it doesn't, because you need to show the realistic cost the machine can realize if it's sold. That's why every year you take out a part of the machinery cost by way of depreciation, and that is called as the reduction of the asset basically. So in the 3rd year, the machinery will be recorded at just $40,000. That is $20,000 reduction for 3 years period. Remember this thing: every property, plant and equipment will be is subject to depreciation, except for one: land and natural resources. They are not subject to depreciation. They are subject to depletion. In case of land, mostly even that depletion is not allowed because land value is appreciating day by day. It never depreciates, to be honest. The land is the only scarce resource which is, even in the remotest corner of the world, it has an increasing value only. And the 3rd category of the assets are intangible assets. Now, the intangible assets are the financial assets without any physical substance, without any physical existence. They cannot be seen, they cannot be touched, they cannot be felt. An example of that, best example of that is a goodwill. The company's goodwill. Many times the company purchases another company by paying an additional cost above their fair value of the assets and liabilities. That is towards the goodwill, the brand which the reputation which the company has bought. So that is an intangible asset. The patent, the trademarks which the company carries on for itself, those are all a part of the intangible assets. Similar to this thing, even the liabilities are classified into two categories: current liabilities and non-current liabilities. The concept remains the same. Current liabilities are those which are expected to be settled in the ordinary course of business during the longer of 1 year from the balance sheet date or the operating cycle. The major categories of, I'm not going to go in depth to explain you now the whole concept of operating cycle. I believe you're aware of that by now. So I'll just quickly dive into the example, what kind of current liabilities are there, what kind of non-current liabilities are there, and then we'll go and look at an example on a balance sheet. Current liabilities majorly include trade payables, that is your vendors, the other payables arising from operations such as accrued wages, salaries, rental payables, royalties payable, income tax payable for the current year of operations, and so on. The unearned revenue, that is basically collection of revenue in advance from customer. This is mainly in case of subscription business model where customers pay you a 6 months of subscription in advance. There, because you have not delivered your service, the sale is not yet actually happened, you need to record it as a liability. Suppose in case you're not able to fulfill your promise, you need to return the money back. So that's a liability you're carrying on till now. But because it's due within the next 1 year, you classify as current liability. If it's more than a year or the operating cycle, you put it in the non-current liability section. Even that's one important thing to note. Now, the non-current liabilities are those which are basically, going to be, which are not current liabilities. The same concept over here. Non-current liabilities are those which are not basically current liabilities. These can include the bonds payable, bonds issued by the company, the debentures issued by the company, advance from non-current customers. Like as I said, if the advance subscription is received for 2 years, you're going to split it into two parts. Half of the part goes to the current liabilities, half goes to the non-current liabilities because that's due after the next year. With this thing in mind, I hope you have a clear understanding at least a basic understanding of what does the balance sheet look like, what are the financial statements, what is the statement of financial position going to comprise of, and so on. Now, it's not necessary for you to understand the entire balance sheet in depth. There are many more elements to cover in that if you go in that area. But it is advantageous to know the basic concept of a balance sheet because that helps you to understand how your project is going to be evaluated, how your project is going to come in the company's books of account, how at the end of the term, end of the reporting period, how is your assets and liabilities utilized by you, created by you, going to be reported in the company's books of account. Now, we'll quickly look at an example of a balance sheet and that should help you to make your concept much more clear. So this is an example on a balance sheet over here. If you see the fact over here, the asset section comprises of three things: current and non-current assets. The non-current are classified further into investment, the fixed assets, and the intangibles. That is all this area, investment, fixed assets, and intangibles, they comprise the non-current assets. Over here, the current liabilities and the rest is non-current liabilities. And another component which comes over here is the shareholders' equity. And the total of the assets is equal to your liabilities plus your stockholders' equity. So let's quickly go to the items one by one to get a quick understanding of why this item forms a part of the current or a non-current section. Okay, in the asset side, we have the cash, obviously readily realizable. Debtors due within the next 1 year or within the operating cycle, prepaid expenses realizable within the next 1 year. That's why these all form a part of the current asset. Investment, plant expansion fund. The company has been keeping a part of the earnings aside to and has been investing in another profitable securities, and that intention is just to replace the plant. So many times it happens that the companies have purchased a plant which has useful of 10 years, but the cost to procure the plant is huge and it takes a big amount of cash flow to generate the whole amount in one shot. So companies every year for the next 10 years will put a part of the amount inside so that at the end of 10th year, when the existing plant is retired, they have readily available new plant. Sorry, they have the funds available with them readily to purchase a new plant then. Then investment in marketable securities. Here the surplus cash, surplus funds are invested for generating better returns, but the intention is to hold them at least, or sell them after completion of 1 year, and so they form a part of investment. Fixed assets, land, building, machinery, all are fixed assets. And make sure you note one thing: these are reported net of depreciation. That is the actual realizable value. Intangible, as we said, that's just one example here. Goodwill. Company purchased the assets or procure another company, and the additional cost paid towards its net book value assets is classified as a goodwill over here. In the current liability section, we have accounts payable, salaries and wages due, income tax payable. So all these three, they are due within the next 1 year or within the next operating cycle. Hence, they form part of current liability. In the non-current liabilities, we have the long-term bonds, the debentures issued, that is all due after a period of 1 year. Lastly, we have the shareholders' equity, that is a capital stock, retained earnings, and so on. That gives you the total stockholders' liabilities and stockholders' equity. Before we proceed to the next part, there's one important note which I wanted to make. A balance sheet is always prepared at the corporate level, so it is difficult to break it down to individual project level. So the point is that it's literally not feasible enough. It is possible, but it's not feasible enough to prepare the balance sheet at a individual project wise. And the main reason over here, if you notice that in the liability section we have this long-term bonds. Now these bonds can be issued to raise a capital which is accessible for every project the company has undertaken, as well as for the common activities for the organization also. Let's say a part of the bond is utilized for procuring a new office, expansion of the office where every employee sits, okay, for bringing every employee to the centralized location. So in that case, it's difficult to allocate the part of the bond to the projects over here. So that's why balance sheet is always prepared at the organization level, not at the individual project levels. Okay. With this thing, we complete our concept on balance sheet. In the next session, we're going to start with the income statements. Now we're going to look at the next component of the financial statement, next element of the financial statement, that is income statement, commonly known as a profit and loss statement. So we'll just try to study it on the same lines of balance sheet. Like, what does it represent? What is the purpose? How is it useful for the project management wise and stuff like that. So first of all, let us understand what does a profit and loss statement represent. So as the name suggests, the profit and loss statement represents the profit or loss earned by the entity over a period of time. Now that time can be a daily basis, weekly basis, quarterly, monthly, yearly, any time. Unlike balance sheet, it is not required that a profit and loss statement has to be there for a one particular day. Profit and loss statement can represent any given time frame. It can represent up to a period of 10 years, 1 year, 5 years, anything you name it, you can make it. Okay. So that's what is profit and loss statement. It represents the profit and loss, or you can say in a way it gives you the net results of your activities done for a period of time, and that activities will comprise certain income generating things, certain expenses. The net result will be either profit or a loss. So that's what is done by the profit and loss statement. The profit and loss statement elements are revenues. Now these are the inflows, or you can say the earnings arising by performing core operations of the company, not any other activity, just core operations. Let's say if the company is engaged in the business of providing service, educational coaching, okay, but if in case of that education coaching, it had an auditorium and it leased it out and it gave it out for some corporate events and stuff like that, those income from the renting out of the auditorium won't come in revenue, they will come under gains. So gains are basically those inflows arising from performing activities other than revenue generating activities, whereas revenues are those inflows which arise from the core operations of the company, undertaking the core activities of the organization. On the same line, we have the expenses and losses. Now, expenses are basically the outflow, the reverse of the revenues. They are the outflows which are occurring because of performance of the core operations of the company. Okay, because the company is involved in education service, it needs to pay its content developers. So that is an expense for the company. But because the company is letting out the auditorium on a weekly, on a rental basis as per the occasions, as per one-off thing, it needs to pay an additional housekeeping guy to clean the auditorium. So that is a loss for the company. In a way, an expense or an outflow from performing other than core operations of the company. So that was all with regard to the elements of profit and loss statement. 4 elements: revenue, gains, expense, losses. And unlike like we had a relationship in the balance sheet, we also have their relationship in the income statement. Your income or your loss, either of things are going to be there. It's never going to be both of them, and that's a basic thing. You cannot have a plus and minus simultaneously. It will be either a plus figure or a minus figure. Will be equal to all the revenue and gains minus all your expense and losses. So all the positive or the incoming minus all the outgoing. That gives you the net result, either an income or a loss. Just let's quickly look at an example in the same lines as we looked at for the balance sheet, and that will help us understand what exactly is an income statement prepared. So here, if you see net sales $800,000 less the cost of goods sold. So here, this net sales forms a part of your revenue, and this cost of goods sold forms a part of your expense, because these are performed towards operating, or you can say the revenue generating activities of the company. Again, selling expenses, these again form a part of your expense because they are performed for day-to-day core operations of the entity. Administrative expenses, they also form a part of your expense, because without these administrative expenses, the core operations cannot be performed. Other revenue and gains, these are part of your gains. This can be by sale of a machinery, by additionally renting out the premises, and so on. Other expense and losses, these are part of your losses, because these are generated not because of the performance of the core operations of the company, but because of any additional other activity. It can be like sale of a machinery for a loss. Possible, right? I had a machinery, I sold it for a loss because it was not giving any value, so I just decided to convert some cash on it, but I did realize a loss on that. How did that happen? Suppose I had an old typewriter, okay, an antique typewriter worth $2,000, but nobody's willing to type, nobody's using that. I found a buyer on a Craigslist or a eBay for $500. I sold it for $500. I made a loss of $1,500 because the value of the typewriter was $2,000, but I had to sell it for $500. That means I made a loss of $1,500 over here. So that is how you book an expense, you realize and loss, and you realize other gains and revenues. That gives you your income before taxes, less the income taxes, and that gives you your net income over here. So I hope with this thing you got a quick glimpse into how the financial statements and balance sheet are prepared. How do you interpret the financial statement? How do you interpret the balance sheet, and so on? In the next session, we're going to see an example on how a project managers can plan, can defend themselves, can defend their projects by utilization of the income statement and the financial ratios. That will help you to understand and the importance of knowing the financial concepts pretty well. Okay, I'll see you in the next session. Till then, if you are from non-financial background, just make sure to go through the financial slides, at least the balance sheet and income statement again. Till then, have a great study time.